month of November has seen an excellent bull run, one of the best bull runs in the stock market in quite a while. And I'm going to play 4 pieces for you to give you a perspective of what, and plus my comments about what they see and what I see going forward. Among those are 2 people I respect, Mike Wilson from Morgan Stanley and Mohammed ElArian. I'm Ben Reppond. Welcome to my YouTube broadcast. Today is December 5th, 2023. I'm going to start with Mike Wilson. I began playing clips from him about a year ago, almost exactly a year ago, the first week, I think, in December. And he was saying that what's coming is a downturn, a recession, and a pretty big correction, maybe a 20% more correction in the market. And he bases, and what I'm going to say is that today he is saying, I got it wrong. And he's going to explain why he got it wrong. It's very interesting. He takes his information from Morgan Stanley follows, I don't know how many, but I'm going to say hundreds, maybe thousands of companies, and their analysts call those companies and talk to the CFOs and CEOs and say, what do you see coming? What is your expectation in the future of earnings? Well, they look at sales and earnings and business environment and so forth. But earnings is what really Morgan Stanley focuses on, and a lot of people do. It's called fundamental analysis when you use that type of an approach. And they put all of this data into the computer, they analyze it, they look at historical patterns, and come up with an assessment. And so he bases his opinion or his forecast not on opinion of I think this, I think that, but more based on fundamental analysis. So, but with all of the computers and the brains in Morgan Stanley, they got it wrong. Mike Wilson got it wrong. And he admits it. And so that's what I really like about him, is he's willing to stick his neck out, make a prediction, price, time frame, rationale, etc. I mean, very few people are willing to do that. And because if you do, you're going to get it wrong some. And but he made his forecast last year, and he stuck with it, and he adjusted it a little bit as time went on, and the market did not do what he said he was predicting. And it wasn't a bull market, but there were periods of gain in the market, kind of taking away some of the expectations that he'd built in. But he stuck with it. Well, now the market has rallied big time in November. And there's a reason for it. It's because interest rates started coming down and bond yields started going up. Bond yields came down, interest rates came down. And so, but he admits it. And then he does a forecast for this coming year. You may say, well, if he got it that wrong, I'm not going to follow Mike Wilson. But keep in mind, Mike Wilson was voted by his peers on Wall Street as the #1 institutional money manager. I forget the title, but it's something like that, on Wall Street. #1. And it's not the first time he's gotten that voted #1 many times, because he does tend to get it right. And he also, his rationale is very good. But anyway, he says he got it wrong. And but he points out in this video that the market has done well, but up until this last month, what's happened is the Magnificent Seven, and you could extend it to 10, he says 10, but then he says 7, stocks, the technology stocks, have really carried the market. The rest of the market, besides those 7, has not done very well, and many of them have gone down. And so it's a very weak market, except for those 7. What happened in November was that the market turned around. Bond yields started to come down, bond prices started to come up. There was enthusiasm in the market because the expectation was that the Fed is done raising rates and they're going to start lowering them sometime in 2024. And that gave impetus to the market, and it just took off. Mike Wilson was and Morgan Stanley was sort of caught flat-footed, and they didn't really, he implies they really didn't shift very quickly, or maybe didn't shift much at all. And I think a lot of money managers were in the same boat. Our approach, and I use this to make a point, our approach is technical analysis. We do not use fundamental analysis. So we shifted, we were in cash for 6 weeks while the market was declining in August, September, and October. 6 of those weeks, the last 6, we were in cash or in money market funds. And but because we use fundamental analysis, technical analysis, we shifted on the 4th day of November, the 4th market day. So we stayed in money market funds the first 3 days and the 4th day. At the end of the 4th day, we entered the market and rode the market up during the month of November during the using the index that was the prominent index, which was NASDAQ 100. And then the last couple of days of November, we shifted. As the market shifted, we shifted over to the Dow Industrials, which were in favor at the end of November. But anyway, my point is that we got exposure, we got market exposure during that period of time, and we made up for, because of our use of the best index, we made up for the fact that we were out of the market those first 4 days by being in a strong index. But it really makes a very strong case for technical analysis versus fundamental, because fundamental analysis, people who are locked into that, like Mike Wilson and others, they kind of stay there. They don't like make a quick shift like that. They're like, no, fundamentals say that we should stay out of the market. Now, in the long run or in the intermediate term, he may be right. The market may turn down, and he implies that in the month of December, that he thinks that, maybe that what they had been expecting to happen will happen. We don't know. But anyway, I thought it was a good assessment. Now, I devoted over 5 minutes of time to his interview, and I thought it was worth playing. I picked the piece that I thought really you'd want to hear, and hear his rationale. We're going to hear from some other people, but let's start with Mike Wilson.
So Mike Wilson is with us. Every quarter you come on, regardless of what's happening, your work is extraordinary, as we've said. Dan mentioned you just got voted again #1 in what? What is that thing?
II, #1.
Which is remarkable, because you know why? That's your peers that vote on that, and they obviously think the world of your work, as do we. So as we sit here with the S&P 4550 thereabouts, it's surprising me. Where do you sort of gauge things right now? Because I know your thesis hasn't changed, and quite frankly, all the things that you thought would happen are actually getting worse. It's just not manifesting itself in the stock market.
Yeah, it's been an interesting year, frustrating, as you say, because the fundamental call that we've had has actually played out in spades through most of the economy. Now, of course, there's these 10 stocks that have done a terrific job of managing costs, and that's effectuated a pretty good earnings recovery for the S&P, because there's such a large weight in that. But the average stock and most stocks are not having a good year because it's a difficult operating environment. The earnings picture is pretty crummy. The macro environment is, I say, tenuous at best. The only thing really going for the market right now is that we're at the end of the Fed hiking cycle, and we're doing the Pavlovian response for like the 5th time, by the way, since a year ago. We made that call that, of course, almost took Danny to the hospital a year ago, where we got bullish. We got bullish on the Fed pivot a year ago. Okay, it kind of worked into the year end. And then I feel like we've had the Fed pivot call like 4 times, and then this is the next one. This is probably the real one. This is the one where they actually probably are done. They probably did their last hike in July. So let's go back to October, because September and October, I felt like okay, the thesis really is playing out. I mean, we started seeing all the very interest rate sensitive parts of the market really take a walloping. I mean, the Russell was down 20% from the July highs to the October lows. The S&P equal weight was down 15. Even the S&P was down 10. The mega caps weren't trading particularly well. And then we had this incredible reversal in the bond market. Now, some people will say, most people will say that was Powell getting more dovish. I don't agree with that. I think Powell's just kind of saying what he's always been saying. I think what happened was the bond market was very offsides. People were very short the bond market. There was nobody willing to step in. And then what I would argue is the Treasury, they orchestrated probably the best short covering squeeze I've ever seen in my life. I mean, they basically guided to this coupon issuance that last summer, and then they kind of issued to a less number, and that's all it took. And then you got a lot of real buying on the back of that because, look, at a 5% 10-year, there was a ton of money waiting to make that trade. And so here we are, 70 basis points lower. And I think that explains probably 90% of the rally that we saw in November. I didn't catch it, so bad on us. But it doesn't change my general view that we're still in a very late cycle environment. The Fed is finished, sure, but be careful, what that really means for growth next year. And it's not a good sign for growth.
We're going to talk about growth. You had a note out, kind of giving your 2024 sort of targets and looking out even beyond that 2025. But just talking about the 10-year and that move that it made from, let's call it the start of September, in around 4%, right? Up to 5%, right? So that was at mid-October or so. And that's when we had the S&P careening lower. Like you said, it was down 10% from its summer highs here. Now, here we are, we're back at those levels. We're back at 4.3 or something like that in the 10-year, but the S&P is 45.50 or so, right? So it's up 11% in a straight line. I think it's like 3 weeks or something like that. So what is it discounting right here? You've said that we've had that Pavlovian response a few times here. I feel like if all the things that you're looking at from an economic standpoint are going to start to come together as we get into the new year, the stock market is not discounting a whole heck of a lot right now with a 13 VIX also.
Yeah, I mean, part of the stock market is, right? Once again, we have this tale of two cities where the lower quality, securities are trading poorly. Yeah. So look, this is classic. This is exactly what happens at the end of the cycle, which is you get very narrow. The market gravitates towards high quality things that they think can actually generate the earnings growth. Now, this year was a special situation because last year, these 7 companies that everybody's in love with did a terrible job of managing costs in 2022. So that set them up for a very easy comparison year now. So 24 is going to be harder for these companies. There's one in particular that has real top line growth acceleration. The other ones don't. It's a cost cutting story. So it's just going to be harder now for those companies to continue to generate the earnings growth that they did this year off of the more difficult comparisons. So look, I think we're discounting a softish recovery with some reacceleration next year. Our economists who aren't looking for a recession, aren't looking for any reacceleration. And I think that that's actually the worst outcome is you get like a 1.5% GDP year next year. Companies don't really fire people aggressively. You don't have a recession, hard landing, but the Fed also really can't cut that aggressively. So right now, what's priced into the curve is about 3 cuts next year, starting either in March or in June. That's not really going to be enough to get these weaker companies off the mat, in my view. So for now, you just want to stay up the quality curve. We're waiting for the event, the final blow, to either send us into a recession or some indication that there is going to be a reacceleration, like some exogenous positive shock, which I don't really see. But I mean, we can make one up, but I don't really see where that's coming from.
Second piece I want to play is an interview that Sarah Eisen does with Young-Yu Ma. And I've not played him before, but he's well respected, extremely well educated. And but her interview with him I thought was insightful. He says the market, and this kind of was my feeling as well, the market got too optimistic in November, baking in about 125 basis point decrease in interest rates from the Fed in 2024. That's a lot. Now, if they do 25 basis points per cut, that would be 5 cuts in 2024. Anyway, however they do it, 125 is probably more than reality. And as a result, the market got ahead of itself. And so he's saying, I think, for now the market has momentum, but be careful because November probably looked too good. It needed to come off of those lows at the end of October, and as a result, by comparison, it looks extremely good. But I think that what I read into his message is be careful. So take a listen to Young Yu Ma.
For some reaction and a look at the markets heading into 2024, let's bring in BMO Wealth Management CIO Young Yu Ma. Young, your first take, Young Yu, on the comments that we're getting from Chair Powell.
Yeah, great to be here, Sarah. More or less as expected. We did think there'd be some pushback on the idea of what the markets are pricing in now, a little bit more aggressiveness or optimism with cutting rates early, and certainly the Fed is not going to just fall in line with that messaging. But I do think that a lot of elements are in place that the Fed is seen as fairly optimistic. But we want to keep in mind that the Fed is going to have the experience of the 1970s really front and center, which Chairman Powell has talked about many times, when the Fed really eased up or took their foot off the brakes too soon and inflation made a resurgence. So I think the Fed is really in it for the long game, and the market is a bit too optimistic in terms of pricing and rate cuts earlier in the year next year.
Why do you think the market's too optimistic?
Well, I think that's
Just
happened
because
many
Powell is
times,
saying
right?
too soon to speculate on when to lower rates? That's
Well,
never
it's not
stopped the
too soon
market
to
before.
speculate, but we think the Fed will stick to these levels for quite some time, and it's probably more of a summer or perhaps second half story when rates start getting cut. But that said, let's take the big picture in mind. The trajectory is probably still more important than the actual timing. Whether it happens in the late spring, in the summer, as long as that trajectory is in place, as long as inflation keeps falling, and as long as growth stays stable, I think the markets are still in a good place here.
Next, I want to play a piece that Brian Sullivan at CNBC does with Ryan Dietrich from Carson, and he gives Dietrich the credit for this. Dietrich, at the beginning of 2023, called it correctly. Market is going up from here. Very few people. Now remember, 2022 was very down, and at the end of 2022, the expectation was it was going to continue down. So Ryan Dietrich said, no, we're reversing and going up. So I think he called it correctly, and Brian Sullivan gave him credit for that. He expects a small pullback, maybe from here, I'll say December or maybe early 2024. But in general, beyond that, he is bullish for 2024. So we'll see. So far he got it right. Then he interviews Sarah Kuntz, and she expects bond yields to fall, which means bond prices are going to continue to go up. They have been going up for the last few weeks. And so if that happens, that's probably good for the market as well. So take a listen to these interviews with Ryan Dietrich and Sarah Kuntz.
Let's take it to our A-list panel to kick it off. Joining us once again, Carson Group Chief Market Strategist Ryan Dietrich and Clio Capital Managing Director Sarah Kuntz. Guys, thanks. Listen, it's Friday. We appreciate you joining us live. Ryan, you've been long. You've been right. Not a lot of people were optimistic at the beginning of the year. You stuck to it. Great call. Congratulations. But what have you done for us lately? Where are we going from here?
Yeah, Sully, thanks for having me back, and happy Friday, everybody. Listen, near term, could we have a little pullback after literally, as we've all know, one of the best months we've seen in a long time? Sure. But you mentioned the Dow. You look at total return, Brian, it's at an all-time high, all right, since 1896. Let's see, It's May 26, 1896. The Dow's come back to all-time highs every time. We didn't think this time would be any different, and we're there. So again, I know a lot of guests on CNBC have been talking about this, but we are impressed with the market breadth. The market today, okay, whatever. Look at small caps, look at mid caps, look at transports. The cyclical areas, financials are finally taking the baton. I know big cap techs pulled back a little bit. I think that's really healthy, right? I've come on with you for a while saying we like small caps, we like mid caps, we like cyclicals because there's no recession coming, and the Fed is likely done, and we've seen what's happened. So I think the market might have a little break here. year, don't forget, last point here, the second half of December, Brian's when most of that strength in Santa Claus, kind of hard to say, Santa Claus tends to come to town. So maybe we're due for a little break, but we're still bullish. We think new all-time highs are probably around the corner.
I did not have an 1896 reference on my bingo card just months before William McKinley beat William Jennings Bryan in the presidential election.
Yep.
Wow. Sarah, how are we going to make money in 2024? I mean, by the way, it's not just bonds that are up. It's not just stocks that are up. Europe is up. Many markets in Europe are doing better than us. Many markets in Asia are doing better than us. I have no idea what to expect from next year.
Yeah, I think that we're going to see possibly a tactical run up in stocks next year. As these bond yields, eventually move lower, as these money market funds stop giving out that 5% plus. I don't know if the Fed's quite done, but I certainly don't think they have more than one hike left in them. And so eventually those yields are going to come down, and all of that kind of historic amount of cash that's just sitting on the sidelines in those money markets, in those bonds, it's going to look for yield somewhere. And for the most part, that's going to be the stock market. People who are really risk on, right, are already dipping their toes back into crypto. Sector, venture capital might see some more action, but the reality is most of it's going to go into the stock market, not necessarily driven by fundamentals. And all of that money coming in, in a relatively short amount of time is going to drive the market up. And so I think next year likely will be a good year.
Sarah, I'll go back to you because there's a lot of smart people that we've had on this network all year long, and no disrespect to them whatsoever, who kind of made the counter argument, and obviously it was not correct, which is, bond yields are going to rise, and so that's going to sap money from the stock market. You can get 5% risk-free. That's going to kill stocks. It didn't. And to me, that's the most surprising thing.
Yeah, it certainly didn't kill stocks, but when you look at the amount of money that's sitting in bonds, after the banking crisis in March, the amount of people who all of a sudden said, wait, one, if I put my money in a sweep account, it's more protected, and two, I'm making how much yield? We saw a huge shift into that, both on retail and Main Street. And so I think that it certainly didn't, kill the stock market, but the reality is that as those returns get less attractive, I do think we will see even more money go back into stocks.
So finally, I want to play a piece from Mohammed ElArian. He always comes up with insights that nobody seems to pick up on, and they're usually right. So that's why they have him on all the time, because he's just incredibly insightful. One thing he says that is a headwind, it talks about headwinds for the market and headwinds for the economy. One of them is corporate bond maturities are coming up in 2025, a lot of them coming up, meaning that as the bonds are maturing, they're going to have to reset those, and of course they will be resetting them at probably higher interest rates. And the market will actually start to anticipate that in 2024 because they know it's coming in 2025. So he said that, that's not to say there's going to be a recession or a market decline. It's just that there is a headwind and it puts pressure on the market. Their geopolitical risk is higher than has been expected. So that is not very baked into the market or the pricing of equities. And he said we had an upside surprise, meaning the interest rates began to fall and bond yields began to fall. And that, again, just like Mike Wilson said, caught everyone by surprise. So those who were able to shift, were able to take advantage of that. But otherwise, people were not expecting it. They were expecting bond yields to stay high and probably go higher. Same with interest rates. But it has shifted and has brought in a positive element into the market. But I think I would pick up from his comments. You can listen for yourself on this, but the comments that I picked up on were still be cautious because there are headwinds for the market ahead of us. Take a listen.
Joining us right now for more on the markets, we want to bring in Mohammed ElArian. He is Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Mohammed, what do you think of that scenario that Sri laid out?
It wouldn't be my base case. It would be my risk scenario. We still haven't adjusted to higher rates. He pointed out commercial real estate. I would also point out a wall of maturity, of corporate maturities coming in 2025 that are going to start playing out in 2024 because companies will be keen to refinance. It is a risk, but it is not a base case that this will happen over the next 3 months.
I think he also overlaid with that just the geopolitical risks around the globe right now. I think that's part of what has him thinking that this is something that we could wake up any morning and have a bigger surprise.
Yeah, I think what makes people uncomfortable, Becky, is that consensus forecast coming into 2023 was quite negative. Lots of people were predicting a recession, and no one saw the geopolitical developments that we've had. So had they seen the geopolitical developments, that would have been more negative. In reality, we've done really well. They would have been
more wrong, right?
Yeah, they would have been more wrong. In reality, we've done really well. And I think that upside surprise has led people to be overly optimistic about next year. I'm not saying the baseline is going to be the massive financial accident he's talking about, but I do think that consensus forecast right now is too optimistic about the global economy.
Well, thank you for watching. If the Federal Reserve really wants to help curb inflation, just send them my grocery bill. You shopping at the grocery store is no different than me. Isn't it shocking, the prices? And you can go through all the various items. Everything seems to be up a lot. And even though inflation may be coming down in the short run, it's not coming down from the original price. It's coming down. It's just increasing at a slower rate. So thank you for watching. If you have comments or questions, leave them in the comment section below. Thank you.